Let's move on to the next panel. So this is exciting. This is going to be focused on the democratization of credit. And the panel is titled The Future of FinTech, How AI is Expanding Fair Access to Credit. And we have Kareem Saleh, founder and CEO of Fairplay, Rhett Roberts, co-founder and CEO of LoanPro, Annie Delgado, Chief Risk Officer at Upstart, Julapa Jagtiani, Senior Economic Advisor and Economist at the Philadelphia Fed. And this will be moderated by Evan Weinberger from Bloomberg. So let's give it up.
Hey, good morning, everybody. I'm Evan Weinberger. I'm with Bloomberg. I cover banking and fintech, and I'm sure I've spoken to a lot of you about a lot of these issues in the past. But you're not here to listen to me, so I'd love it if my panelists here could introduce themselves. Then we start at the end with Kareem.
Yeah. Hey, everybody. Kareem Saleh, founder and CEO of Fairplay. We cheekily refer to ourselves as the world's first fairness as a service company. We allow anybody using an algorithm to make a high-stakes decision about someone's life to answer 5 questions. Are my decisions fair? If not, why not? Could they be fairer? What's the economic impact to our business of being fairer? And finally, did we give our declines, the folks we rejected, a second look to make sure we didn't deny somebody an opportunity they deserved? Some of the biggest names in American finance use our tools to automate their fair lending testing and reporting and to optimize their decisions to be fairer within their risk tolerance.
Hi, everyone. I'm Annie Delgado. I'm Chief Risk Officer at Upstart. Upstart is a financial technology company that partners with a network of 100+ banks and credit unions to offer a sort of cradle-to-grave marketing through collections experience for the consumer, powered largely by AI. We leverage AI in everything from our marketing practices through underwriting, pricing, verifications, fraud detection, and in the servicing and collection space as well.
Hi, Rhett Roberts, founder of LoanPro. So Utah company here, and excited to be presenting and having the conversation today. So we provide software that manages loans to both private credit, financial institutions, credit cards. Think from the in the life cycle of a loan, from the point of decision through the long tail, the rest of the life loan. So compliance, optimization, modernization, and personalization, things about how you manage and make these loans not only meet the lifestyle of the consumer or the borrower, but also do it in a compliant way in the operating system to do that.
Julapa Jagtiani, I'm Senior Economic Advisor at the Philly Fed. I thank you very much to the Spring Lab and the organizing team for having me. And everything that I say today is my own view, not the views of the Federal Reserve Bank of Philadelphia or the Federal Reserve System.
Okay, so the title of the panel is How AI is Expanding Fair Access to Credit. So maybe we'll just start out with that question broadly. How is AI expanding fair access to credit? And what are some of the pitfalls that you're seeing come up for companies as they do this? Maybe, Julapa, do you want to start?
Sure. So AI, well, financial inclusion has been my favorite topic. I have been doing research in this area for many, many years. And the use of alternative data in conjunction with complex modeling like AI, machine learning, has been part of my research. And we have been arguing, and many believe that using alternative data with AI and machine learning modeling would help lenders have a much better, more holistic understanding of the person. And so hopefully they would be able to identify what they call the invisible prime of the subprime pool of consumers. So that belief, I look at the data and well, first of all, we have to recognize that not all fintech lenders are the same. And so I look at the specific lending platform and found that the use of alternative data combined with this machine learning model could enhance accuracy in predicting default significantly, and some of these ratings that these platforms assign for non-prime consumers could be A or B rated, top rated, and allowing them to access credit at a much lower rate than otherwise. So that study that is for consumer loan, and we also have used a separate data platform that look at small business lending and find similar results. So I think, yes, and we have a separate paper that look at fintech partnership as well, but we will talk about it later. But yes, confirming hypothesis that the data shows that there is a potential for enhancing credit access to non-prime consumers.
Yeah, and Rhett, Kareem, Annie, your companies are all using AI. How are you seeing it affect your lending decisions? How does it make it easier to find people that might have fallen through the cracks before?
Yeah, I think there's the answer to the sort of the first question, how can AI expand access to credit? There's two things that are talked about broadly, which is, approval rates and pricing. So all else equal, we find that by using AI and alternative data, you can approve more people at lower rates. One thing I think also is not talked about enough is how much it can improve the process of getting a loan and make that a much faster and more efficient process. If you talk about all of the sort of credit invisibles and the near prime or the hidden prime that we all want to find, underwriting those people is actually very challenging and very expensive if you're using sort of traditional methods. And it's not only hard for them to get into maybe a branch and bring all of their documentation and have all that go well. So a lot of times people just can't serve them. Banks can't serve them because it's so expensive to do so. But AI can really solve a lot of that problem by making it easier to verify those people's income, leverage things like cash flow data to sort of look at alternative ways to underwrite the individual. And so you can actually bring them into the mainstream credit system. By approving them, you can offer them a lower rate than they might get at a payday lender or some other type of, whatever their next best option might be, and it can be a much faster process. So those are really the three big opportunities that we see.
Yeah, our experience is consistent with that. I mean, we see the opportunity to use AI to paint a much finer portrait of an applicant's ability and willingness to repay a loan. So it's not uncommon for us to see increases in approval rates on the order of 10%, increases in take rates on the order of 13% due to optimized pricing, and increases in positive outcomes for historically disadvantaged groups on the order of 20%. So good for profits, good for people, good for progress. On the, what are the pitfalls side of the ledger, the problem, of course, is that machine learning models are capable of learning the wrong things. And that is in part because oftentimes they derive their power from finding interactions between variables. And sometimes those seemingly fair variables can be interacting in ways to encode information that no human could possibly understand. Let me give you an example of that. We work with a subprime auto lender. They have a big piece of their portfolio is in Nevada. And for whatever reason, I guess Nevadans have a slightly elevated risk of default. I don't know if Nevadans are more risk-seeking. I don't know if there's something macroeconomically going in Nevada. But one of the variables in their model was, do you live in Nevada? States are really big. That variable does not present obvious redlining concerns, made it past compliance and into the model. A second variable that they were using in their model was what was the mileage on the car that was proposed to be purchased? And if you think about it, that's a totally reasonable credit signal, right? Like the higher the mileage of the car, the more likely it is to break down. The more likely the car is to break down, the more likely you are to miss work. The more likely you are to miss work, the more likely you are to lose your job and miss a payment, right? So what's the mileage of the car and do you live in Nevada? Two seemingly reasonable variables with an intuitive nexus to creditworthiness. There's just one problem. If you're buying a high mileage car in Nevada, there's like a 70% probability that you're a person of color. So you think you're making decisions on the basis of state and mileage, you're actually making decisions potentially on the basis of a sensitive attribute or protected class. So the challenge with using these AI systems is how do you maximize the predictive power of these variables and these models while minimizing the adverse effects they're having on historically underserved groups. That is possible to do. We do it every day. But that's kind of key to making sure that you're harnessing AI for good.
That's a great example. So thinking about a lot of customers we use, they're doing loan or portfolio management. Loans of different flavors, might be an auto loan portfolio, which is where I started. We owned some car dealerships with my brothers, and that led us into auto lending. And then auto lending, we needed software to manage our own portfolio of loans. We didn't have an issue like sourcing, underwriting, decision. We had an issue of get your money back in a compliant way after you give the loan. So fast forward 20 years to present day, that software we built internally to our own company is what we offer to double-digit percentage U.S. population of the platform. We see some interesting trends, right? And so it's not just, I want to go up like 50,000 feet, right? The question of expanding access to credit, like we all have an assumption that is good versus is bad, right? And so how do we do it in a diminished risk way? And we're seeing some big trends in B2B. So small business, the regulatory environment is sort of a barbell, right? It's either consumer lending or it's corporate lending, but then there's a gray area and it sort of depends, throw a dart if people think it's consumer or if it's corporate. So think of like factoring receivables for an Uber driver. Is that a consumer loan? Is that on the corporate side? And as we talk to a lot of folks, we see them happen on both sides. And so we think that the regulatory environment on this access to credit, the regulatory environment is going to incrementally just change the definition of consumer. And it's going to add a couple of words on what consumer means, and it's just going to erode a big chunk and get rid of it being a barbell on the regulatory side, but what it is subject to the consumer side. I bring that up because a lot of the technology platforms that are built are either built for corporate lending or for consumer lending. And the data inputs and the framework of those don't play nice on in-betweens. And so we see a huge opportunity in access to credit for, especially post-COVID, people trying to do their own gig, and they'll go out and figure something out, and they can't really be underwritten super well with consumer data. Go fetch data from a third party, bring it back, and well, they're not using that money for like personal consumption, and so the underwriting models don't super work that way. Or if you do approve them, then it's going to be based off of their personal capacity to pay and not necessarily based off of the new gig that they're trying to do. So we see a big push. This is beyond just consumer side, but really a lot of activity happening in the B2B side of things where this is providing access to capital, and capitalism works, but it has an assumption of access to capital to let that process flow.
I would add that, so what Kareem said, the mileage, car mileage is one of the factors that could determine default, but also related to race and gender. Now, banks have trouble proving using this AI and alternative data because even something like home ownership could also be tied to race and gender. And so generally, if you ask banks if they use alternative data, it's you would not. They use it for AI for KYC, but they would not say that you use it for. They use it for credit decisioning. It's also very hard to differentiate different alternative data. Like for people who have a mortgage, they could use credit, whatever their payment would enhance their FICO score, and that's part of the credit decision. That's fine. But if they don't have a home and they actually pay rent regularly, that doesn't count as traditional data. That becomes alternative data, which is very highly related to ability to pay. So it's kind of confusing.
So I think Rhett mentioned regulators, and I think they play a big role here. And they're famously risk averse. How do you get them comfortable with the use of these AI models, and how do you get them to see what you're doing and sort of address some of the concerns? Kareem's example of Nevada was a really good one. I could see a fair lending concern there on their part. How do you get them to see what you're doing and accept it?
So obviously not an easy thing to do. I think for us, transparency and proactive dialogue is the key. I really believe that if you get a bunch of people with different viewpoints to the table, you can usually come up with something that's even better than whatever you came with individually. And so the partnership between the traditional financial institution, who, by the way, are oftentimes more risk averse than the regulators and the fintechs getting in a room and talking about what the goal is and really trying to educate how the technology works. Look at data. Data doesn't lie, which is a beautiful thing about it. But a lot of times, we think it lies to ourselves because we might have intuitions where some data set sounds scary or icky, but when you actually look at the numbers, it doesn't prove out that way. And so really being willing to come to the table and have conversations and show your data is a huge thing. At Upstart, we've we tried to take a very proactive approach, not just with regulators, but also with the industry. We participated in the CFPB No Action Letter process. We also did a public monitorship with Realm and Colfax to bring some of our data forward and sort of encourage the conversations, because if everybody's afraid to talk about progress, then there will be no progress, right? So we have to actually be willing to engage in the hard questions.
Go ahead.
No, please.
Sure. So it's a great question, and we're at a conference digging into a couple weeds. So at the risk of being a little too nerdy, I want to talk about like how do you actually do it, right? So when I was in elementary school, and maybe you guys had the same experience, but the way they would present information was an overhead projector, and you'd put a transparent paper on, right? You draw whatever on it, and then so the visual I like to put in my mind is imagine that you have an overhead projector, you put on the paper, and then you start stacking these on top of one another. And the visual you get up on the screen is some version of like a Venn diagram with whatever shape. And I think that's important. Each sheet, each layer that goes on there is a different rule or requirement. Because I think everybody in the room would bet that one of the outcomes of the political divide in our country is that the regulatory environment is A, there's uncertainty, and B, the volatility of the rules changing is going to continue. And so if this is like a yo-yo effect coming back and forth. And so having the layers of delineating, this is the tripwire of where I'm supposed to color within the lines, and I can track where the problem's at. And so then you can have a stack of, it's getting kind of long list depending on the regulatory environment. You might have the alphabet of the different regulations of FFIEC and OCC and so forth through the list. But now it's not a black box, right? You fetch a bunch of data, you use it in decisioning. By the way, this isn't just giving a loan up front before you give them the money. This is long tail during the whole process of how you service and manage a loan. The panel before us, I saw that the title was like early warning. Well, you got 90% of the same regulations on that stuff too. So think of like a line of credit or a credit card. Should you change their credit limit amount? Well, some things that would be a very good, like if you're optimizing for performance of the portfolio, you can't just change credit limit amounts based off if they did a swipe at a hospital. Right? Well, there's some laws that you're going to break in that process. Well, those rules keep changing. So I think that the practicality of how you do it is you have these layers of your guardrails or your controls, and then you have the transparency to it. You have to take your models and backwards test your population and see how it applies, and see this subset of this model is not going to work. And then when the regulator comes in and you look at your portfolio and how things are doing, it's not this mystery black box of I fetched a bunch of data and I did this brain thing and it spit out my answer and I backwards tested my answers on fair lending. Right? Instead, you can say, nope, it's not a black box at all. Here's my model. Here's all of my layers of the rules and requirements. And this is the tripwire that's getting hit. And I think that's a much better way to design it, because I'm betting the rules keep changing. So you just swap out your papers, and then you can see where the tripwires are going to hit for the model.
Yeah, I think that the regulators are actually not nearly as negative on AI as you might think. In fact, I think what they seem to be saying, first of all, a few years ago, all of the federal financial regulators kind of locked arms and made a very strong statement in favor of cash flow underwriting. The first no action letter given by the CFPB was given to Upstart in connection with its use of machine learning models and alternative data. There's a group of ex-regulators at a place called FinReg Lab. These are former Bureau and OCC officials who've basically given the industry a blueprint for how to use AI in a safe and compliant manner in credit underwriting. There was a recent statement from the CFPB on adverse action notifications, and they didn't come out and say don't use AI. They just kind of said if you're using AI, make sure that you can state with specificity why your AI declined someone. So I think actually the message from the regulators is much more nuanced. I think the message is, hey, if you're going to use underwriting for the AI age, you can't govern that AI with compliance tools from the Stone Age, right? So you have to be as sophisticated in your governance of these systems as you are in your use of them.
So I think it seems like I need to say something as a regulator here on the panel. So I don't think regulations, actually the goals have never changed, right? As a bank regulator, we do care about consumer protection, privacy, safety and soundness, financial stability. And so generally when the landscape changes, there are some new products and behaviors that change. So the new guidelines generally would come out, and as Kareem said, yes. So even if it's not inside the black box, so it's all the documentation is all there, but there are like thousands of pages, right? And so we need to make sure that banks actually understand the model and also would be able to tell consumers why the loan is denied. Like because we saw an example years ago when Goldman Sachs and Apple credit card that gave credit limit to much higher credit limit to the husband than the wife, and they're basically the same household and same household income. So there are something in the model that actually unintentionally could bias the outcome, and I think that data could be obsolete, that could be biased, all kinds of issues with the data. If the input is bad, then definitely we need to pay attention to the output. And so that's what regulators are planning to do. And I see that banks and fintechs are becoming very similar. The difference between the two actually have become quite blur. Many of the fintechs have become banks, and banks actually have acquired fintech. Over COVID, for example, Amex on some banks actually acquire fintech platforms which are operating now in the bank.
So we've established that regulators are, I guess, a little bit more comfortable with AI than you would think. But banks, there's a lot of focus on bank partnerships with fintechs at the regulators. A lot of enforcement actions recently. I think some banks are pulling back from that. How are your companies navigating this issue? How do you get banks to be more comfortable with this in this regulatory environment?
I'll go first. I love this comment. This is great. So the explainability needs to be one of the goals, right? That the clear why you're making a decision in the process. And so having that transparency and the explainability and removing black boxes, right? And I think that's a key piece. And doing it in a way that the model's flexible enough that as you learn things and as maybe the framework changes a little bit of a new data input of a guardrail, that you don't have to start over on your model. You can adjust with it. So we partner with, or our customers, about half of them partner with a financial institution, either for capital side of things or for a license, the few different kinds of partnerships. And some of the enforcement action happen when you read in detail through it. You're like, well, I mean, why did you even try to do that, right? So some of them are kind of silly, and they're like low-hanging fruit, like they didn't do KYC at all, or like. So I don't think I'm going to opine on those at all, because I think everybody in the room understands you got to do those things, and those are like a meal ticket. I would say that we're seeing the models change, where the partner bank is no longer accepting attestation from their partners to say, hey, I did these things, but instead they're saying, hey, if you want to onboard a customer, call my API or engage with me, and in the process, I will take care of those things. instead of just saying that you attest that you took care of those things. So that we're seeing a big trend change on that, which is arguably the way that it probably always should have been. Just a brief, look at a lot of the partner bank models. I'll use, you could pick anyone, they're almost the exact same thing, but use like Cross River, right? The playbook at Cross River was, hey, we're gonna do this cool new thing. We're gonna start with payments, build an API, call it, it's a native system to do payments, and you could call their API and engage in payments, and they did a lot of cool things around payments. And then they said, okay, great, let's also do deposits. Oh, let's build that. And they built the deposit side. Oh, there's a couple pieces there. We got KYC, we have a few things for onboarding and stuff. So some of them built those as when you call into their API to onboard and create a new account, in the happy path of creating that account, they do KYC. Others said, oh, let's make that optional. The fintech that I work with attests that they did that. That's where a lot of people got into trouble. And then almost all of them moved down from payments, deposits, then they moved to lending, and they go, whoa, there's a lot there. Just send me a file, right? Like just send me the daily file of where you're for your loan tape. And so we work with a lot of folks to say, well, maybe that logic at the beginning of it, here's a platform that we're going to assure the loans are running in the right way. Excuse me, that should be the same kind of solution. So I think that there's a big trend towards just not splitting out the responsibilities and recognizing who's responsible for what, and removing a couple of the options so that they can't find themselves in a dangerous place.
I think the question that you asked is such an important one for the industry to tackle, because for me, one of the biggest opportunities when it comes to bank fintech partnerships is that it's going to give small and medium banks the ability to compete with the larger banks, because as consumers, we all expect everything like Amazon Prime speed, Uber speed, right? And the small community banks can't deliver that in the same way that a Chase could or something like that. And so bank fintech partnerships are critical to keeping competition alive with banks, but it'll be stifled and potentially killed if they're so afraid to do that, because it's so expensive to figure out how to do oversight. And so really making sure that we get this right, I think is important. For us, when we partner with our banks, obviously there's a lot that goes into the diligence that the bank does on us. We have very open book with them to give all of our documentation and policies and procedures and sandbox. We also do a couple of different certification programs. One that's on sort of how the program works and how the bank has configured their program, but then another one that's just literally a technical training on how AI works. Because one of the things that we find can happen in an examination cycle is the bank can know the technology inside and out, and actually have done a really strong job at diligence, and then sit in front of an examiner and get asked some other question about some other area of AI that they didn't learn about because it's not relevant to the program, and then all of a sudden their confidence is drained and they are in a position of fear with their examination. And you never want to be in that situation. So really making sure that banks are educated on how AI works is really important, so that they feel confident explaining how they're overseeing the programs when they go in to sit in front of their examiners.
Yeah, one point I'll make about bank fintech partnerships that kind of arises from our world, the fair lending world. There was a big sponsor bank that received a consent order on fair lending issues. I think it was last year, May of last year. And the most important thing to know about that consent order, it's roughly 34 pages. It's about fair lending, and it uses the phrase ongoing monitoring like 26 times, right? And so what we're seeing is that the bar for compliance, especially kind of for fair lending compliance resulting from the use of AI models, that is going from a kind of low rigor, low frequency transaction to a much higher rigor, higher frequency transaction. The good news is that, like, if you invest in technology, it can actually make your partnership with the fintech run a lot more smoothly, right? Because if you're going to do ongoing monitoring of your AI, well, then every single time you want to add a data source, change an approval threshold, push a new variant of a model, you need to very quickly be able to make judgments about whether or not that proposed change is going to pose a threat either to the safety and soundness of your institution or to the consumers you serve. And I don't think that's a problem you can solve with bodies. It's a problem you have to solve with technology.
So bank fintech partnership has some type of partnership is now defined as a novel activity. And so that is would be subject to special, more closely monitoring and supervision, and particularly if it is related to lending decision, credit decision. So I'll talk about my research that look at the impact of fintech partnership and look at, actually we use Y14 stress test data to look at loan level and to look at the bank's behavior in terms of their willingness to make loans to non-prime consumers before and after this relevant fintech partnership. And so we often find that first we look at smaller banks as well, the credit offer. But when we focus on large banks, CCAR banks, we find that often the likelihood of offering to non-prime consumers actually doesn't really change. But for those that they decide to deal with, they tend to increase the amount of loan or total credit card limit or mortgage loans, larger loans to those non-prime consumers. We also look at default rate to see how the default rate changes for non-prime loans before and after fintech partnership. And we find that on average, the default rate declined a little because they actually have a much better understanding of the consumers that they deal with. And but that varies from bank to bank and depending on the partners.
Okay, so we're starting to run out of time. So I just wanted to shift gears a little bit. So we've talked a lot about credit decision making and how AI is used in that. I think that's sort of a more traditional use of AI, but there's also now the growth of generative AI and ChatGPT, things like that nature. How is that working into the access to credit discussions, and are there specific dangers there that don't exist with the other models? Kareem, do you want to go first?
Yeah, sure. So everybody knows that like predictive AI has been used in financial services forever, and predictive AI is all about like classification. Like, is this image of a cat? Is this image a cat or a dog? Or is this applicant a good credit or a bad credit? The benefit of predictive AI is that like there are increasingly good methods to explain it. There are increasingly good methods to debias it. Where generative AI poses a problem is that the outputs of generative AI are all fundamentally creative. Right? It's like, can I produce audio like a human? Can I produce text like a human? Can I produce an image like a human? And the models are very, very computationally complex. So they're very, very hard to explain. They're extremely hard to debias because if the outputs are creative, like how do you debias an idea? Well, you need a definition of fairness. And of course, the problem is that the definition of what is a fair idea changes all the time, right? Like what was considered a fair idea 30 years ago is different from what's considered a fair idea today. And then, of course, finally, you have this problem of hallucination, which is like, given the same set of inputs, you cannot be assured that the outputs from your generative AI are going to be the same thing. So how do you know that the generative AI is going to say the same thing to this customer that it said to that customer? And by the way, we're starting to see some very interesting lawsuits about this stuff. You may have seen this case in the UK where Ryanair, I guess there was some like aggrieved consumer, maybe they had a flight canceled or something, calls into the call centers dealing with the generative AI bot. And I guess at some point the generative AI bot feels a lot of empathy for this aggrieved consumer because the generative AI bot invented essentially a loyalty program and enrolled that consumer in a new loyalty program so that they could, fly for free in the future. Of course, that loyalty program didn't exist. And Ryanair was sued in connection with that. And the court said, no, you're on the hook for what that chatbot told that consumer. So I think there's a lot of very cool, very powerful applications of generative AI in financial services, but unless you can explain it, unless you can debias it, unless you can prevent it from hallucinating, you're going to have really, really strict guardrails around the applications.
Kareem, good ideas can come from anywhere. Maybe they needed a loyalty program. That might have just been like a genuinely good idea.
Yeah.
I think generative AI, like as Kareem mentioned, totally different sort of set of risks than predictive AI, but I always also like to look at the opportunity. And one thing that I found for predictive AI for credit modeling is actually de-risking it is a lot less scary than trying to de-risk a bunch of human underwriters. Like, I tried to do that before I moved into fintech, and let me tell you, that was a scary job. It's really hard. It's a lot of training. You don't really know what's going on up there. But when you have sort of a centralized, quote unquote, brain that you can manipulate, you can make a lot of progress. And I think the same will happen over time with the generative AI as well, right? Because instead of having, an army of call center agents who are potentially going to make up loyalty programs or say things off color or do who knows what, you have a centralized controlled system that you can develop to say what you want it to say. And I think that we're really at the forefront of just trying to sort of explore that as an industry, but I think the sky's the limit in terms of opportunity. And as a risk officer, I feel a lot more confident about de-risking that than about like the call center situation. So
that's a great comment. I love the example there, right? They're two different use cases, right? We've got a number of folks who use our system, right? We're primarily a loan servicing platform. And so the natural use of generative AI will be like call interception or deflection process or other self-service kinds of methods. And what we find is that the large language model has to be fed with the right data set. And any of you who've gone to play with ChatGPT, you get some weird answers, right? But generally, you get the right framework. It gives you the general format. It's framed roughly the right way. Now, you just can't trust all of the content in there because maybe it learned something wrong, whatever. So what we're finding is the low-hanging fruit that everybody seems to be working on is at a interaction or touch point with the customer. So like a customer can call in, they'll talk to a generative AI attendant that sounds like a human, and they can speak in a natural language. And it'll figure, so you don't have to prompt it exactly. You don't have to say, what is my principal balance? You can say something like, what do I owe? And it will be able to figure those out in a natural language. And it can use not just a generative AI, but also overlaying predictive. It can say, I think you want to ask these things, and I can engage with you. And then, of course, we saw the release from the White House a few weeks back, this idea there has to be an escalation path into a human. And so it can like say, hey, they're getting frustrated, and so let me escalate. And so they've got a couple clever ways to do it and to add some personality to it. So I think that's the first use of generative AI. Second is we're finding that most folks are doing a two-layer approach. They're using a open source generative AI for framework of the answer, but and then adding a second layer of only source the content from a closed ecosystem of the data set. So think of like your facts and all of your material that you would want to serve. As you're training your own model, you may want to use an open source for the framework, but you don't trust the answer, but you know it's going to give the general framework of that answer, but then do the second step of only your own large language model of that data set, so you trust that. And so we're finding that's kind of the stair-step approach of how folks are getting into that. We can speak about it a long time, but we're finding this exact point here that Annie made is that it's less risky doing that than it is having a bunch of humans answer the phone, and who knows what they're going to say too.
So I personally believe in the potential of AI, and particularly in for financial industry overall. I think, though, that the generative AI, we are in such an early stage that we cannot trust it for banking at this time, but there is a real potential. Have to be very careful.
All right, so we only have a couple of minutes left. And there were a lot of things that we didn't get into. But I just wanted to see, we have an election coming up. I just want to see how people think AI policy might change moving forward in the next few months, next few years. Nobody wants to touch that one, do they? No.
You know, I tend to think not very much, to be honest with you. I mean, if you look, former President Trump had an executive order on AI, and his executive order on AI actually talked quite a bit about the use of AI consistent with American values. And so my sense is that AI might actually be one of the areas where there's rare bipartisan agreement, that these systems represent kind of the future in terms of our competitive edge as a country, but that they might also, run our businesses off a cliff or have a 5 to 10% chance of extinction. So my guess is, yeah, it is pretty high actually. So my guess is actually that while there may be some differences around the margin, and I think, by the way, if you look at the federal financial regulators, both under President Trump, I mean, those are folks who also, like, the reasonable people, came from industry, like, brought fair lending cases in some cases. So I think there may be some changes at the margin, but I actually don't think that bank regulation is going to change dramatically, regardless of what the outcome is in November.
I agree. I think it's a global topic, not necessarily the U.S. that decide on the future of AI.
I agree too, and what I would say, I hope, is that because of some of that bipartisan agreement, that we can see hopefully more of a federal framework than a state-by-state patchwork, because I think that's where we actually have more risk, is if we have certain states where you're allowed to do things and not other words. We don't want to get into the sort of Europe situation where it's very complex and hard to figure out how to comply and where the goalpost is. So a lot of the sort of AI technology that all of us are enjoying are non-enjoyable in Europe because, people are afraid to get into it because of the regulatory patchwork. So I'm hopeful that the federal government is going to be useful in clarifying this for us.
I agree that the election change there. I think there's general support in that one. I think the way that maybe some differences might occur is the how rapid the expansion of something like 1033 occurs. And so maybe it's not necessarily a challenge on the AI side, but more like what data can you do what with and how that gets permissioned. And so as long as you're building in such a way that it can be aware of your data inputs and the transparency that happens. But it seems like there's general alignment that we're making this advance and that we should be at the forefront of that.
And I wish we had time to talk more about 1033, but we'll leave you with a couple of thoughts. The AI is either going to end the world or give us airline miles. And so let's hope for airline miles. Thanks very much, everybody.
Thank you.